Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a sunny and beautiful Denver, Colorado. I'm pleased to be joined in the chat today by my friend Barb Armstrong. She'll be in there momentarily. Looks like we had a little bit of a hiccup getting the chat loaded for her, but she's going to get in there and manage comments and questions that I'm unable to get to for you today. But it is a solo day here for Trader Talk. And of course, in those instances, I want to hear from you. So please feel free posting for the duration of the show. We're going to go about 45 minutes in total here, everyone. So with that in mind, let me remind you of some important details. First of all, remember you can follow us on X. I'm there at Kevin Horner CS. Barb, of course, is at Barb Armstrong CS. Looks like we are joined by Scott Thompson here in the chat this morning. You can say hey to Scott as he'll probably manage things for us before Barb gets in there a little later. So with that, let's take a look at our disclosures so that we can get into the discussion and start looking at a bunch of charts, of course. So first of all, remember that our discussion here is only informational and educational. Simply put, that means we do not make recommendations. We do not make endorsements for a specific method to trading the market here. What we will discuss, however, is technical analysis. We bring up the concepts and strategies that traders might choose to employ in their own trading here. But these are all just ideas, never a recommendation. And further, we want to remind you that with regard to technical analysis, this should be just considered a piece of your overall decision-making puzzle, not the entirety of the decision-making puzzle. So please keep that in mind as well. All right, as far as our agenda is concerned, everyone, it's going to be more of the same. We take a top-down methodology here as we review the broad market in Trader Talk. So we're going to look at the S&P 500, the NASDAQ 100, the Russell 2000, the semiconductors. We'll certainly look for leadership and laggers in our sector action on the day. And on a solo day, I really enjoy getting to a bunch of individual stocks. We've got some upgrades, we've got some downgrades, some intriguing charts in both of those. So we're going to try to get to a number of key individual stocks for you here today as well. So with that, let's kick it off with a look at the S&P 500, which did make a bit of a bounce back move yesterday, everyone. You'll notice we had this lovely hammer candle on Tuesday morning following our long weekend, of course. We had opened weekly. We stayed weak for the majority of the morning. And then in the latter portion of the session on Tuesday, we finished bullishly. So we had a nice green candle with a close basically at the highs. Yesterday, we got a follow-through day. It wasn't exactly easy slate, an easy sledding day, meaning we did open okay, opened through the high, but we didn't exactly create this incredible range day. It finished beautifully, not a problem with that. We like the fact, if you're bullish, that is, that you're back above the 20-day moving average. And today, as you can see with a little bit of green on the candle for the moment, we are seeing a little bit of optimism carrying us. So depending on your process, everyone, you might have taken a little bit off with the week open on Tuesday morning, but many traders will lean as much as they can into those closing values. And so some of you may have been enthused or at least encouraged by that hammer candle late on Tuesday and may have stayed the course. If you're one of those traders who is looking for some semblance of confirmation beyond a single day below a moving average, like the one we got on Tuesday there, or the one we got back here at the end of, or rather the very first day of August, if you're needing more confirmation, chances of a breakdown, chances are you've not been taken out of your majority position in the S&P 500 because we've only been below those moving that 20-day for one day here and one day here. So a lot of traders are still taking the view that while we've been below the 20-day, we continue to make higher lows or at worst matching lows, right? So matching low in here, coincident with that 50-day right beneath us, matching lows back here, also coincident with that 50-day at that moment in time. But ultimately, what I'm getting at is to make sure you know the levels where you want to take action. That might be below the 20-day. Some of you might still have comfort. Maybe you want that below the 50-day because we've not violated the 50-day on the S&P for quite a while here, of course. In fact, since it's been recaptured back here on May 1, we have not violated the 50-day on the SPX. Okay, so some of my basic idioms apply here. Remember to set the levels where you will look to take action. A reminder, technical analysis doesn't predict anything for us. What it allows us to do is to state that because this level was taken out on a closing basis, well, now my risk tolerance is different. Meaning, if we traded under that 50-day moving average here, then the probabilities on a closing basis, I'm going to state, under the 50-day on a close means that we have an increased probability of a deeper pullback, not a guaranteed probability, not even a guarantee that we've got to test the ledge beneath us at 6,200, but just an increased probability that we would. And it would take that level of price action, a close below the 50-day, to increase the likelihood of a move lower. The fact that we continue to make one-day move below the 20-day, for example, and then get right back above it, often speaks to the interest in buying up these dips. And you can see it playing out even in the short run. So reminder is to listen to the narratives, be aware of the narratives, but not allow the narrative necessarily to drive your decision making. Allow price action to dictate that. You could maybe be a little more comfortable. Now, remember to be confident in your positioning. So if you're feeling less comfortable at these elevated levels, less comfortable by virtue of the fact that we've just gone sideways maybe for the last month plus, then you can surely be building cash and putting yourself in a more comfortable overall investment position. But you don't have to think bearishly or take bearish positions to be feeling a little uncomfortable here. You can absolutely do that just by building cash. So keep that in mind as well. Now, one thing we're going to notice when we move over to the NASDAQ is that the test here on the NASDAQ has been at the 50-day. Now, we've drawn in some details. I'm going to go ahead and eliminate these details because while I talked about this with Brent yesterday, the fact is we tested the 50-day here. Okay, yes, it looks like, yeah, we could call this a little head and shoulder-ish in the very short term, right? With the left shoulder here, the right shoulder a little elevated, and the head elevated still. So yes, we could talk about that as such, but remember that this is simply the potential of a head and shoulder pattern. It is not a head and shoulder unless we break the so-called neckline. For a lot of traders, that neckline in this instance depends on how you draw it. And of course, one of the things about technical analysis, we often say, technical analysis is far more an art. It's not a science. And so the way you define a neckline for a lot of traders is going to be to look at the low trade we have seen in the development of said head and shoulder pattern. And so for a lot of traders, they're going to call out the low in here. And so they might think that maybe the neckline is a flat level like this. Some traders might say, oh, that's all good, well and good. They might put it a little bit higher. Maybe they look at the neckline and say that a break of the low we just made with Tuesday's open could be a spot for the neckline. Okay, so, and the reason I'm giving you these various views, everyone, is just simply the reminder that while technical analysis is often stated to be a self-fulfilling prophecy, has that level of self-fulfillment involved, right? Because many traders are looking at a lot of the same data points. We do things differently. So neckline 1 could be here, neckline 2 could be here, and heck, we could even draw a slanted neckline if we wanted that kind of coincides with the low that we had on Tuesday, the low we had on this initial pullback as well. You've got a number of key levels for consideration of a broken uptrend. And unfortunately at the moment, I say unfortunate because it's just not clear. When we look at what's going on in the NASDAQ, the one thing we can say is clear is that the uptrend does remain because we do still have higher lows along the way. And the low we made on Tuesday is a matching low, not a lower low. So this looks like short-term low here, right? And then the next level beneath us would be something like this. So all of these are reminders that while we might be tiring over the last month as we've just kind of gone sideways and consolidating, the trends remain held and the 50-day continues to move upward. So that upslope to the 50-day can still be validating, okay? So the 20-day moving average is right overhead for us right now. In fact, let me close this out and then you can see that figure, 23,525 approximately, and we're at 23,458 here on the NDX. So yeah, we would want to, I mean, if we really wanted to get going back again in the trend, get it going in earnest, we may very well want to see the 20-day recaptured quickly. But the reminder here is whether the 20 or the 50, we are seeing a bit of an uptrend continuation pattern here more than anything else. Unfortunately, Rita, as it relates to the NDX index, the SPX index, we're not going to get volume associated with these, unfortunately. So if you're looking for volume as it relates to the indices for some confirmatory signals, unfortunately, you're not going to get it by looking at the indices. You'll have to shift over to something like an exchange traded fund, perhaps, but we don't incorporate those on a Monday, Wednesday, or Thursday. Remember, we incorporate those on Fridays. So check us out tomorrow morning when I'm on in the morning session here for Trader Talk on Friday with my guy James Boyd, and we will absolutely be able to do that for you. So here's where we stand on the NASDAQ. Now, let's move on to our small caps, see what we've got working here. Small caps continuation pattern looks like what we've got. We say continuation because the low we got on Tuesday was bought up. So reminder that we moved through an area of resistance, and the fact is we have held that resistance now since having moved through it. So that can be a validation of the trend, right? We are 1, 2, 3, about 7 or 8 sessions above the red line. And notice how that orange 20-day moving average is upsloping nice and aggressively here, which tells us that we have potentially the opportunity for more of a continuation move, right? We've got the 20-day upsloping into that former support, former resistance, now potential support. In fact, I'm going to go ahead and make the change here. Now, I'm going to make that a green line. I'm going to make that 2315 a green number so that everybody can see that it coincides with that level. And so that becomes a short-term ledge for horizontal and trend support as it relates to the small caps here, the Russell 2000. So that's going to give you something to keep a close eye on. And again, as an example of how some traders in the short term might choose to manage this. The fact is we've been above both the 20 and the 50 all the way back to this oval, right? And this was the right shoulder, potentially, of an inverted head and shoulder, and we've already made that maneuver. So let me just remind us of that. Inverted head and shoulder, left shoulder, head, right shoulder. The neckline is this green line here. And then the approximation of the neckline's move from this green line would take us to this green line. That's the 2315 level. So ultimately what we're saying here is that the inverted head and shoulder pattern played out bullishly, gave us the equivalent move, the depth of the inverted head and shoulder from the neckline to the head to the upside. And that's what this line represented here. So we got the measured move out of things. Now what we're looking for is the continuation. And so once more, we don't know if the Russell is moving up to that next ledge at 2450, right? We don't know that, or let's call it 2440. But what we can say is that as long as the Russell holds the 20-day on a closing basis or holds 2315 on a closing basis, that near-term area of support, as long as that maintains, a lot of traders will stick with their Russell 2000 positions. On a close below the 20-day, they might lighten up some of those Russell 2000 positions, whether that's the index itself or individual small caps. If it closes below the 50-day, that would be a much more significant development in the trend that we've seen here dating back to early April, of course. So a close under the 50 could be the spot where traders just decide to move on from the trade in the Russell. This absolutely remains a bullish trend because the low from April continues to make higher lows along the way and higher highs. Okay, so at least looking at the last 5 months, we can say we definitely have an uptrend working. It is up in the air as to whether that uptrend continues or breaks, but optimism seems to be ruling the roost as it relates to small cap here as well. All right, how about a look at the semiconductors? So let's go here to the SOX. And what we're noting here is a bit of a consolidation playing out. But what about those of you worried about trend? Well, if you're worried about trend, you might have some reasons for a bit of concern here, because for the first time now, we are below the 50-day for what is now 3 days. Now, that doesn't mean that we have to stay below it. For a lot of you, that just implies weakness on the day or the current week. But with what's going on right now, if you are the trader who says, hey, my window is 3 closes below the trend, and if I get 3 closes in a row below what I deem to be supportive, which could be considered the 50-day moving average here, basically up until this week, some traders might be looking at today as a very important day, or maybe it's tomorrow that's a very important day. Whether it's 1 day below the 50-day or now day 3 below the 50-day, it is notable, okay? So remember to have those levels known. Remember to know where you as a trader will take action. So some traders might lighten up because we're below the 50-day for day 3. Some might stay fast to their positions and only close if we closed below the white line here at around 54.65 or so, because ultimately that would increase the likelihood, not make a guarantee in any way, but it would increase the likelihood that we have to go lower before moving back higher. So a close under 54.5 on the SOX would be significant. Now, let's see if we can coincide any of these levels with some Fibonacci retracement ideas. So we're going to draw a Fibonacci retracement from our trough to our peak, and let's see if we can get any of these support ledges to line up. All right, so there's our move. Okay, this is somewhat notable, right? We've got the prior highs right here, which at the time were establishing a bit of a bull flag, right? We went sideways, right in here for about 2 weeks, and then that was just a continuation move. But if I extended this line all the way to the right, well, now we've got another possible ledge of support for us beneath us. That would be the 23% give back. It's not uncommon to see give back of about 23% or maybe 38%. Notice where the 38% retracement is coincident. It is going to be in this vicinity with this prior high and then the 200-day moving average as well. So all of that can play a part in any potential pullback. Doesn't mean we have to get there. Of course, you all know that, but you also know that if we break down further, well, then our odds increase for testing one of these levels of short run support. The reason I bring up the Fibonacci's, though, is the hard part is remembering in the midst of that pullback that we have a good chance of finding a foothold at one of these areas of confluence, whether that's the first ledge, that first oval, which could be right here, right? Or if it's this one down here. So the reason I say that is that, we always, bullish traders almost always say things like, man, if I could just get that pullback in this index or this stock to the level I'm waiting on, if I could just get it to pull back to 5,300, my goodness, would that be an excellent entry? And you'd be right. But that's one, assuming the trend is going to continue there. And two, that you, the trader, are comfortable stepping in at that level. It is not at all uncommon to be ready to go and know the level and still have a challenge to be able to make that purchase. It's often stated that you might know the levels, but being prepared to buy is one thing, but buying when the level gets hit is another. So it can be difficult when it's time to buy to actually follow through and be the buyer. So part of that can be planning for it to get there, right? That's a big part. Ooh, we got executed on one of our example trades we're going to talk about a little bit. So we could say that the trader needs to know the level where they want to take action, but they also need to be willing to take action at that level. And sometimes that might mean piecing into the trade instead of holistically moving in. So yeah, I set the level at 52.80. I want to be a buyer at 52.80, but am I a comfortable buyer with a 100% position, or am I a comfortable buyer who is only willing to buy 25% and wants to be proven right before adding more money to the trade? So again, thought process, having a plan, and then trading the plan that you set for yourself can be really instructive as you're working through your thought process here. So that's what we're looking at on the semis. A little bit weak, a little bit rough as it relates overall to technology. Speaking of technology, let's take a look at some of our sector action. We've got a lot of green in the sector moves today. Our laggers are materials, breathing a little bit after having made a new high, pulling back to the 20-day moving average. Not much concern. Let's look at technology. It continues to be in the midst of a consolidation trade. We did find the 50-day on Tuesday with the open, but again, no real significant shifts. It is significant that the semis are below that 50-day for 3 days in a row, but broadly, technology is not, right? So reminder, every sector has industries and sub-industry groups. Some of them are going to be trending with the sector and some of them are not. It is notable, though, for many traders that the semis are weaker than the broad sector of technology. So just be aware of that at this point. Let's see. How about the leadership for the day? Our number one stock at our group, is discretionary, moving well off of the 20-day. It stands out to me, at least, as a bit of a technician here, that we've not only moved off the 20-day this week right through here. Let me put a line here as potential short run support. But I also point out that when we are trading above that 20-day, as you start moving to new highs, or take out a level of resistance, one of the things we can witness is that we might start trending thereafter. And so the fact that we've moved through the 20-day, back here, we recaptured the 20-day after not just a 50-day test, but a 200-day test right here. We moved back through the 20 and since have been holding the 20 since August 6. So that stands out for some traders, right? Got a test there, a test there, and a test here. Yesterday, you got a hold move. And so now what you're looking at is about 3 plus almost 4 weeks of holding the 20-day moving average. And perhaps the 20-day moving average can give discretionary stocks a bit of a lift here moving forward. Could be the supporting trend line for discretionary. So that's not a negative. That's actually quite positive in the near run, especially if it can start or continue, I should say, as it has for the last month, continue to use the 20-day moving average as support. Well, then you might expect to see a bit more of a rally continuation. Reminder, look at how it went, how aggressive we sold the discretionaries down and how quickly that 20-day moving average was used along the way as resistance. Well, we have been back above it. There was some periods in here where we needed to consolidate the entirety of the space. But now that we're back above it, many traders will start just eyeballing the 20-day now as a potential for trade management going forward. Now, again, watch those recent highs, because any trades through recent highs could be continuation moves going forward. Also, we're getting some leadership out of real estate today, and we're getting some leadership out of utilities today. The likelihood there is linked up with the interest rates, which have fallen. So, remember, we have interest rate sensitive groups like the Russell 2000, right? The small cap stocks are sensitive to interest rates. Lower rates is good for small caps. Lower rates in the yields, or lower yields, I should say, as it relates to the 10-year, is going to be likely telling us that traders and investors alike long-term are going to be looking for more yield, right? Where are you going to get better yield if you're not going to get it from the risk-free rate of return, as it might be referred to, the 10-year note? Well, traders are going to say, if this is breaking down and we're not going to be getting that 4.2% or better from the U.S. Treasury, well, then let's consider being willing to take on more risk in the form of investing in equities and utilities and in real estate for the purpose of getting those dividends. So some traders at some point, investors in the longer haul, are going to start to become a little more willing to take on some equity risk if it means better rates or better returns from their dividend paying investments like utilities and real estate sectors. So that's why you're probably seeing them get a bit of a lift here today, is the drop in the 10-year yields here. Okay, just taking a peek around. I know yesterday we did discuss, I'm going to hit this quickly because yesterday we did spend a little more time on it. If you wanted, you can always go back into the archive and look at yesterday's show, of course, to see the conversation Brent and I had. But I wanted just to briefly, let's pick on gold here real quick. Notice that we did the really a breakout move on Tuesday, a continuation yesterday, and so we're getting a little bit of a breather in gold here today, but ultimately a breakout from a very obvious, I should say, rising or ascending triangle. On the weekly chart, I think it's even more evident here. So there's a big move in gold. We can expect, as a technician, is it out of question to get thrown back to the breakout for a test? Absolutely not. That's certainly a possibility. Let's see how silver looks. Silver with the continuation move yesterday, you got a bit of a doji there yesterday. And then now today you're trading through the low of the high day in the rally. So maybe silver is due for a little bit of a pause potentially, but ultimately it's going to look a little similar to what we've seen in gold, right? Just more of the same. An excellent rising trend. This down below, the green moving average is the 20-week moving average on this weekly, but the white is the 40-week, and it's been a little bit more consistent on silver than, say, the green 20-week. So I just wanted to make sure that we covered those. All right, now let's see about some of these stocks in the news. But before we do, actually, no, let's go to stocks in the news. Let's talk about some upgrades. So one of them that got upgraded today was in our portfolio until just recently. That was Apple. So let me give you the story here. MoffettNathanson analysts upgraded Apple to neutral. Previous level was sell. New target on this is 225, so they are a lagger as it relates to the target at least. Now, they state that a number of key headwinds have faded and, quote, the worst case scenarios are off the table, end quote, according to the analyst. Price discounting in China has lessened the risk of market share losses in the country, while exemptions have almost eliminated the material tariff penalties, according to the analyst, and views Apple as a very expensive stock, however, so be aware of that. Now, that said, you can clearly see that the price action here has worked out favorably. I had drawn in a bit of a bull flag, and ultimately what mattered, I suppose, is that we traded through the high with yesterday's move right there, right? And that looks like the new potential for support. In my case, I had an example trade from I don't think it was last week. Let's take a look here. I can make this real simple by just putting my trades on. Hey, I've made quite a few moves in Apple, huh? The most recent purchase, let's see here, that was bought 100 here, sold them up here, bought them back here. So we can go, let's go to our monitor page, account statement, and let's just look for the most recent 30 days on Apple. Yeah, so we bought them on August 8, and we set a we did a one cancels the other, or an OCO bracket at the time. So we ended up buying the Apple at 223. We set our target based on a potential measured move, and it achieved the target. We got taken out. So that was lovely development for the trade in Apple. It ended up working out to about $16 a share. Now, of course, at this point, some traders might look at this and say, well, now that you're out of it, what now? Well, if you look at this and suggest that, hey, we've got more upside because we've moved through the recent high and created a new level of short run support, a couple of ways to conceive of this now, everyone. Some traders will consider putting an exit strategy under the low we made yesterday. Others might look at the 20-day and pick a level beneath it. And still others might use the 20-day and incorporate something like an average true range beneath it to build in an exit strategy. But many different opportunities there. That one might come up for us in my afternoon class today. That, of course, is the after the close segment that rolls out at market close, 4 p.m. Eastern. Plenty that we'll be discussing here for that. Another upgrade today for you all. How about Brinker? So Brinker got upgraded at Evercore, upgraded to outperform. Previously had been noted as in line. New price target is up $20, up from $190 to $210. Evercore sees upside to the consensus estimates in the near term and sustainable same-store sales growth potential from Brinker's improving customer satisfaction measures. The company is facing some growth tailwinds from its new units and remodels, according to the research analyst note here. So they state that Brinker is the least expensive name in the restaurant coverage on a growth adjusted basis. And specifically, that is the what they state here as the least expensive name is in their analytical approach. So that is Evercore specific. What's interesting to traders might be the price action we've noted here up until today, which was really in consolidation mode, right? Lots of back and forth. Let's see, how does I don't even need to do that. We'll just add the volume profile. There we go. So the volume profile, lots of intrigue here. Traders, check this out. We've got the volume point of control, 152 approximately, coincident with the 200-day moving average in blue. And so that tells us that there's a lot of back and forth at that 200-day level, right? Traders were absolutely wondering, hey, can this position hold up here? Well, a lot of the volume in the last year, in fact, the majority of volume in the last year has come from this 152 level. This is an equilibrium price level where bulls and bears have been fighting it out until today's news, right? Until this upgrade. And now the stock has broken out to the extent that we are trading above the 50-day moving average. Today, intraday, traded as high as we have in the last 2 months. Now it is fading intraday, so I understand having perhaps a little trepidation, but for many traders, the fact that we recaptured the 50-day is the big takeaway here on Brinker. And then I can't get away from this chart without pointing out there's been some improvement in the RSI. Most notable about that improvement, everyone, is that the lows have been held and tested numerous times in the last 2 months, while the rising RSI continues to play out bullishly. This is not a negative as it relates to price action. In fact, many traders would suggest that the move today is validating that RSI heads up that you might have seen over the last month plus. Okay, so this was really intriguing to a lot of traders. And again, on an upgrade opportunity, the fact that it's recaptured the 50-day looks notable. So if traders were looking at Brinker and wanted to give some consideration, you might eyeball the 50-day. Let's see how it closes today. Does it close above the 50-day moving average? If you're a speedier term trader and you want to look at intra-period, a couple of keynotes here. we broke higher on the open and opened at or above R2, which is a real nice validation of the short-term trend, utilizing the pivot points. Ultimately, the pullback came to the 20-period exponential moving average. That's this light blue line here on the chart. And a lot of traders in the midst of these trend days, days where the price action continues to roll, you could utilize the 20-day as your approximation of short-term trend support. Notice here yesterday, Wednesday, Brinker broke out and held that 20-day almost for the entirety of the day until that final 2 hours in the afternoon where things kind of sold down, right? So not a negative, but the move back above it today is kind of notable. And the fact that we've pulled back to that 20 period and it happens to coincide with yesterday's high, some traders would say that that's the perfect spot for a bounce. Now, that remains to be seen. I can't tell you that's the perfect spot for a bounce, but it looks like a spot where traders would say, hey, if the selling was going to stop from the original enthusiastic open, this might be the spot where that selling loses steam and bulls step in. We'll see how that plays out. All right, I've got some more on here from the upgrade downgrade side of things. So let's pick on another one, but we're going to look at this from a downgrade standpoint. And this is in the same space amongst the eateries. So let's check out Texas Roadhouse. Texas Roadhouse has been in a bit of a swoon. We have made a pretty good move from this May peak to today's low. We sold down about 18%. We're down now only about 14.5, 15% from that last peak. But I think what stands out on this chart to me has been this very evident downtrend that now presents as potential resistance continuing, because what do we have above us? That huge volume point of control. So for the last year, once more, what have we seen? An immense amount of volume portrayed or taken back and forth at that equilibrium price, right around 174, 175. We saw a lot of action there for the 2 weeks prior to this breakdown, right? So this is significant, and it could be a spot where any rally loses steam. So we have to be aware of that. Now, the news is that Evercore downgraded Roadhouse to inline from outperform. They put a new target here at 190. That's still fantastic relative to the current price, but 190, I got to call this out, everyone. Note that a move through 190 would mean trading above the 20 and taking out the confluence of the downtrend line, the 50-day moving average, and the 200-day moving average. And that's about to cross to the downside, giving us a potential sell signal in the intermediate to longer term time frame as well. Now, on the weekly chart, we can take a peek here. Not a bad idea. If we did this, let me clean this drawing tool out. Looking at it on the weekly basis, you could see why the low that we just bounced on today, why did that low coincide? Why did that get a bounce? Well, it was the 100-week moving average, as it turns out. So maybe there were buyers waiting for that, right? That's an important level. Under here, that last test of support as well could be an important ledge. But I think for a lot of traders looking at this on a much longer term basis, the 100-week moving average now presents as a pretty important level to maintain. And then beneath it, maybe 149, 150 as a potential level to maintain and monitor. So not a great looking chart, not a great piece of news. We would prefer, if you're bullish, you want to see basically trading above the level of recent highs to kind of give you the confidence that something that's really been struggling is no longer struggling. And even there, even a move up to 177 is going to feel good in the short run, but it won't break the overall downtrend. So you want to be aware of that regardless, right? Okay, let's see. And then I think I've got a couple more on the downgrade front, unfortunately, here. A couple that have been moving. So let's look at Dollar Tree. Dollar Tree had been on just a fantastic maneuver here. This thing had broken through an area of resistance back here and started really running against its 20-day. It's gotten tired in the last month, closed below the 20-day for a few weeks, now took out the 50-day to the downside. They are slated to announce earnings here. Oh, they announced earnings earlier this week, and of course that made the move yesterday. So today what you got was Gordon Haskett downgrading Dollar Tree to reduce from hold. They set a target here at 95, just beneath us. So you should be aware of that. So this follows the Q2 earnings report. Says the firm, Gordon Haskett, is concerned with Dollar Tree's move into these higher price points. The company's traffic decelerated sequentially in the most recent quarter. Gordon Haskett believes the downstream ramifications of Dollar Tree's price changes are immense to their business model. So that doesn't sound favorable, at least as it relates to Gordon Haskett's viewpoint. If we were looking once more for an area that would might provide support, we can do that Fibonacci trade from the lows or the Fibonacci levels, and we can see that there might be a level above us, or pardon me, beneath us, and it could be that 38%. Right in this vicinity, right around 96, 97. Potentially the 50-day, pardon me, the 50% retracement right beneath us at around 90 or so. Just to give you all something for eyeballing, right? Something to keep an eye on here. All right, let's take a look here. We are just about at time, everyone. So I think what I'm going to do is let us do a quick refresh of our major indices here, because what was started out as a lot of green on my screen has kind of seen a little bit of a breather. So we've turned the S&P to just about flat, and we have the NASDAQ negative by a little bit, the Russell almost flipping negative. So quick review on the intraday chart. The SPX is pulled back to that 20-period exponential moving average, so we'll see how this holds up. Certainly could be support for us intraday. If that's the case, and it is in fact supportive, then we have the opportunity to maybe trade through where we paused today, which were the highs not that long ago, right? You know, this technical analysis stuff can start to make sense the more you look at it. The highs from last week as we sold down have been, at least intraday, resistance. In order for us to have a chance to take that out, obviously we need a bounce. And it looks like we're trying to get one right now there in the SPX. What about the NASDAQ, which pulled back, found its actual pivot here. So this represents a good level for potential support. If you're a trader in the near term, the short term, today specifically, under the pivot could be a spot where traders lighten up on an intraday basis. So reminder of that. And then let's look at our small caps, which have faded a little, but not getting too much action here intra-period. But boy, anybody at all surprised? Shouldn't be, because again, where did we run to and where did the run stop? It all coincides with the prior high back here from late last week, or excuse me, just yesterday, and then the pullback to the confluence of our true pivot and the 20-period exponential moving average, which some traders will use as potential short-term intraday support or resistance. So we'll wrap it up there for the time being, everyone. Rates do continue to break lower. Yields are lower, that is. So maybe some upside opportunity for the broader indices if rates do, in fact, continue lower. I'll thank you all for being here, for joining me. Of course, remember to follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. And don't forget, you have an opportunity to come out and see us face to face. We are out and about, of course, at our live events. We're going to be in DC. We're going to be in Chicago. We're going to be in Orlando. We have many dates upcoming. Check that calendar. Remember, it's schwab.com/coaching. And if you'd like to check out the live events, slide down to the tab for it and get registered. Those events fill up fast, but we would love to see you at one of those live events, everybody. So with that, thanks for being here. Big thanks to Barb, and thanks to all of you, everyone. If you like today's conversation, hit that thumbs up button below for me. And don't forget, I will be back with you all for after the close at 4 p.m. Eastern, and we'll set the table for Friday. Thanks, everybody. Have a great afternoon. I'll see you again real soon.